Hey, everybody. Hope everyone's doing well and had a good day overall. We have 1 day left in the month. Right now, the open of the month is 58.07, and we're about a little less than 40 points away from the open of the month. It's possible we get there, but I think one of the problems is, I say that, it's right around right here. We may get down there before and close, but look at this day. Look at the daily chart. The bears need the market to close all the way down here tomorrow in order to get that. And I doubt that's probably going to happen. The single most important thing is on the daily chart, we're in a tight trading range and we're overlapping. We get a bull bar, then a bear bar, and then a bull bar. Bears had an inside bar, it went outside up. Bulls, they had an outside up bar, and look what happened. It went almost outside down, not quite outside down, but the bears reversed yesterday's breakout bar, outside up bar. The bears, they want to double top with here the the October 17th high, as well as somewhere over here. They want to break below the neckline and a measure move down. But at the moment, it looks like the market is going to continue sideways. We have open gaps here, open gaps here. That increases the odds that the channel is going to continue. But right now, the bulls, while the bulls are doing a good job and they have open gaps, they have a magnet above the 6,000 round number, and I think they will get there. I think it's becoming increasingly difficult for a, a bull to continue to hold long below bear bars. The bears, they want a bear breakout below this bull flag here and the measure move down. The bulls, they want the opposite. They want the trend line to hold and they want a reversal up. 5 minute chart on the open, bar one gapped down, and it's a relatively decent bear bar, but it's got a tail below. Big enough gap that we'll probably get a second leg down. As far as buying or selling below one, you can probably do both. Realistically, as far as buying below it, a little bit dangerous. We may fall all the way down here, the low of bar four. We may test the bar seven low right here at the bottom of the channel. And therefore, if you're buying one, it's basically buying near the middle of the range from yesterday, and that makes it a little bit tricky. Two, bear bar closing on its low, good for the bears, probably going at least a little bit lower. So you will have traders selling the close. Three, big bar. And what do you notice? The bears who sold the close of two made one times the risk. And because of that, one moment, excuse me, because of that, you'll have a lot of traders buying back their shorts during three. Three is really not what you want to see if you're a bear looking for a sell to close sell off. It's a big bar at the bottom of a trend, bottom of a trading range. That is not ideal. Four, surprise bar, good for the bull, strong enough bar. We're probably going at least a little bit higher. As far as bears, what do? Well, the bears, this reversed up pretty strong. And because of that, a lot of traders will be relatively quick to buy back their shorts above the bar. And that's what happened with bar five. Bar five, strong bar, closing on its high. If you're a bear and you sold above three or you sold above four, how do you feel? You're obviously holding a losing position at that point. And therefore, you'll have traders buying and buying a pullback, betting on trapped bears. Six, bull bar, three consecutive bull bars. Strong enough breakout will probably get at least a second leg up. So traders will buy it. What do you do if seven's a bear bar closing on its low? You may have some traders get out, but a 3 bar micro channel, probably buyers below. The one problem for the bulls is we're right at the high of the day, bar one high, and we have all this trading range price action over here. So while I do think we're going higher, I don't think we're going a lot higher. Bar seven, four consecutive bull bars, good for the bulls, probably buyers below, and still buy the close on seven. Eight, a bull bar. But what do you notice about eight? Eight has a smaller body relative to six and seven. So you have a buy climax bar five, smaller bar six, bigger buy climax seven, smaller bar eight. This is a sign that the market may pull back over the next few bars. 9, doji, probably buyers below. And then 10, we have a second leg up for the bulls. For the bulls, 10, is it buy the close or sell the close? Well, look what the market's doing. You have traders buying pullbacks, buying as 8 is going down, buying as 9 is going down, and that increases the chances that traders will take profits on bars like 10 and look to buy more lower. 11, bear bar, good for the bears, probably going at least a little bit lower. 12, let me back up. 11, bear bar, good for the bears. We'll probably get a second leg down, but there's still probably bulls buying the close. It's the first bear bar since the rally up from the 4-3 low. And traders will use that as an opportunity to buy. 12, we triggered the high. We triggered the high one above 11, probably sellers above. High one buys typically lead to pullbacks and then trend resumption. As far as buying above 11, if a bull does buy and use a wide stop, I suspect they will make money. But look to the left, you're right in a trading range, and that lowers the probability for traders buying right here. 13, an inside bar, probably still going a little bit higher, but with 4 overlapping bars, makes me think that you're going to have more profit taking and will probably pull back soon. So as far as buying up here, it's a little bit tricky. Do you put a stop below 12? Probably not. There's probably buyers below 12. Do you put it below 6? You can probably put it down here. But if you're buying up here and scaling and putting a stop down here, you really need to be able to scale in lower. 14, doji, probably sellers above, buyers below. 15, outside down, good for the bears, making the market go sideways, increases the odds that we'll find profit taking fairly soon. And then 16, consecutive bear bars. I think it's reasonable for traders to exit somewhere in here or below any bar closing on its low. 17, good bar for the bears. Strong enough bar that will probably get at least a small second leg down. What do you do with the bar? Well, the problem with 17 is it's a relatively big bar and it'll probably get a second leg down. But look at it. It's a pullback after a fairly strong rally. What do you think the bulls are going to do with this bar? You have bulls who are trapped out of the rally looking for any reason to buy. And you have bears who are trapped into a bad trade and they see this. If they sold here and they scaled in, they see this as an opportunity to reduce their loss. Bulls buying the lows of these bars, buying more lower. What do you think they're going to do? A lot of those bulls will use a bounce to exit. 18, we rallied above 17 and we pulled back. Why? Because 16 is a strong enough breakout for a second leg down. And then 19, an inside bar, but after 3 consecutive bear bars, 15, 16, 17, plus the breakout point, the one high, not far above, will probably pull back a little bit lower and test the one high and maybe the open of the day. So not a good buy above 19. 20, bear bar, testing the close of 17. I suspect will probably go at least a little bit lower. 21 consecutive bear bars. Good for the bears. But what do you notice? 2 legs down after a relatively strong rally. Sell off, pause, second leg down. Bears that are short, if they get a bull bar 22 or 23, I think bears will get out and bulls will look to buy. 22, bull bar closing on its high. Good for the bulls. It's a second entry, 2 legs down, 17, 22. And therefore, always in bulls that got out below 15 or 16 will be relatively quick to, let me say it differently. Always in bulls that got out below 15 will probably look to buy above 22, or if 22 goes to the upside. 23 consecutive bull bars, good for the bulls, probably going at least a little bit higher. And then 24, strong breakout bar. But look at the context. It's a relatively big bar, forcing traders to buy relatively high. That's not ideal for the bulls and increases the risk that the market may pull back. Big bar at resistance, top of a trading range, really not an area where traders should be buying. But 3 consecutive bull bars, it's a 3-bar micro channel. I suspect buyers below. 25, bear bar closing on its low. Good for the bears, but a low probability sell below the bar, especially after the 3-bar micro channel. probably a minor reversal, and the odds are we're probably going above the 15 high. Bears, if they sell below 25, stop above 15, think about the risk reward. Their risk is small, and the reward might be a measured move down to 58, 55. And that means they have great risk reward and low probability. Whenever you have great risk reward, you know you have low probability. Outside up, bull bar 26, good for the bulls, probably going at least a little bit higher, but a disappointment 25. And then 27 consecutive bull bars, good for the bulls. But again, because of 25, I suspect there will be traders selling below 25 and scaling in higher, meaning the low of 25 is a magnet for the market's test later in the day. 26 bear bar, probably sellers above. For the bulls, they'll see it as for the bears, they'll see it as a wedge. Rally to 25, pullback, rally 27, pullback, rally 28. That'd be a wedge top. Next, they in a trading range, and they'll want the reversal down. Second leg up on 29, but relatively weak, increases the odds that traders will sell it. And then 30, a bear bar, always in bulls. I think it's reasonable to get out at this point. Too much risk we break out to the downside. 31, bad high one, probably sellers above. 32, bear bar, breaking out of the tight trading range, good for the bears. Bear bar closing when it's low. Looks like we're probably going to go at least a little bit lower. 33, okay, follow through. It's a bear bar, so probably going to get at least a small second leg. 34, another bear bar, good for the bears. Traders selling, they put it stop above 32 or 31, betting on a breakout below bar 21 in a measured move down. So in other words, the bears, they want this, a measured move. We also had a reasonable sell to close bar on 3, and it's possible that the market has to get all the way back down to it. 35, doji, bull bar, probably sellers above and a second leg down. 36, a doji. 37, a bull bar. What about buying above it? Well, if you're buying above 37, you're taking a low probability stop entry with a lot of bars in a tight channel, and that increases the risk there might be more sellers above rather than buyers. We formed a bear bar 38, 39, doji 40, bear bar 41. We're trying to form a bear channel, but the bear channel is really tight, all the bars below the moving average, and bulls are not making money. The bulls have not made money since somewhere around 26 with the stop entry. And because of that, it increases the odds that we might be forming a small pullback bear sell off. Bear bar 42, closing on its low. I think it's wise for bulls if they're long to get out below. And then 43, we formed a bull bar, but look what happened on the next bar. We sold off. Why? Because this is a very tight channel and it's a breakout on a higher time frame. Whenever you get a tight channel, you know it's a micro channel on a different time frame, and that'll increase the odds that there's buyers below. 45, pullback from the 44, low one, but I suspect sellers above and a second leg down. 46, an inside bar, possible final flag, but we're getting a lot of bars below the moving average. And then 47, outside down. This was a minor reversal up. 47, the bears, they see it as a breakout pullback sell, and they want a strong breakout below the bear channel. And then 48, relatively strong bar. Is it exhaustion? It's possible, but there's a few problems. One, tight bear channel, and we're breaking below the bear channel, and we're breaking below this trading range low right here. As big as, even though 48 might be climactic, the odds favor a second leg, and therefore, if you're a bull, it's better to wait for a second leg down. Consecutive bear bars, 48, 49, probably strong enough breakout for a second leg down. But what do you notice? You're right near the bottom third of the range. Strong bear breakout, second leg down, likely, but we may get a deep pullback first. We had a bad buy signal bar above 3, and therefore we may just be getting a sell vacuum test of the 3 low. Another bear bar, 49 on 50. Good for the bears, but 4 consecutive bear bars. And 48's big, 49's bigger. And then 50, what do you notice? 50 rallied and then sold off, and the body is a little bit smaller. And that's a warning that the market may not be as strong. That's a warning that traders are starting to take profits. Bull bar 51, good for the bulls, but probably minor reversal after the micro channel up to 48. but the minor reversal could be really deep. It could test all the way up to the 21 low. Consecutive bull bars, 51, 52, good for the bulls, but we rallied, pulled back, and rallied, and therefore, if we get a bear bar on 53, that would be an implied low too. 53 outside down, not a great stop entry for the bears, testing near the close of 50. Disappointed bears sell the close, scaling in higher, getting out break even. Probably buyers below the current bar in the 52 low. 54 bear bar closing on its low, but we sold off, pulled back, sold off again, and therefore 51 is a breakout pullback sell. You can also call it a low one, and that increases the odds that there's buyers below and we get a reversal up, and that's what happened with 55. 55 good for the bulls, probably going at least a little bit higher. 56 also good for the bulls, but what do you notice? Rally, pullback, second leg. We have two legs up in an overall trading range right at the 21 breakout point low. If you're a bull and you bought the 21 low during 48 and you bought more lower, think about what you're doing. You're probably interested in getting out break even. If for the bulls, if they're long with 56, a lot of those bulls will exit below a bear bar, which means if we get a bar like 57, those bulls will be quick to sell out of longs. 58, bear bar closing on its low, and then 59 immediately reversed up. 58 spent a lot of time. You can't see the bar, but if you look on a smaller time frame, 58 did not go straight down in a strong manner. It went down, pulled back, down, pulled back. So if we go to 1320 on a 1 minute chart, you can see it right here. We have a micro channel, but hesitation, sell off, pause, sell off, pullback, inside bar, sell off, pullback, sell off. That's parabolic behavior, and it increases the risk of a deep pullback. Retest of the 56 high on 59, but I suspect sellers above. And then 60, bear bar closing on its low. We have a double top break below the neckline, 58. Bears want to measure move down, but I suspect buyers on the close of 60. 61 in bull bar, but a doji, probably sellers above, but not a great buy below the bar. It's bad follow through after 60, so it looks like we're in a bear leg in a trading range. Doji 61, doji 62, doji 63, doji 64. We're in a tight trading range, holding below the moving average increases the risk that we may have to test all the way down to the 50 close. Strong bear breakout, deep pullback. This might be a bear flag that leads to a breakout below 51. Bulls buying 64, the triangle, bad follow through 65, and then a reversal 66. We may try and go the opposite direction, and that's what happened with 67. 67, relative surprise, strong enough breakout for a second leg, but tail below the bar increased the risk of a deep pullback. You had limit order bulls buying the 66 low, the 63 low, the 61 low, and you can see on 68 and 69, a lot of those bulls who bought and scaled in tried to get out. 68, not a strong stop entry buy, and 69, not great follow through. Tail in 68, tail in 69 increase the risk that the market ends up going more sideways rather than straight up. The bulls, they want a failed breakout of the 51 low, break above the neckline 58, and measure move up. And you can see instead the market went sideways to down. The bears tried to get the bulls tried to get a bear channel. We sold off on 68, reversed up. We went sideways. We broke to the downside 74 and reversed up. But again, bulls can't make money above this bull bar. And they're unable to make money above this bar as well. And then 78, strong bear breakout and then reversal up. You can see what's happening. It's a bear breakout below the bear channel. The other problem is here is the low of the day. And so if you buy above 78 and you put a stop below 78, you're in essence putting a stop right at the bottom of a trading range. And look what happened on the next bar. The next bar actually broke below 78 and the low of the day and then rallied to the upside. And you can see a measured move from the high of 57 to the low of 51. The risk for the bears became within the measured move projects to 39.75, and the market tested to it came within 2 ticks of that price level. 79 were a strong reversal up, good for the bulls, but big bar with big risk. If you buy the close of 79 and you put a stop right here, it's actually a bad trade. This is your risk, and the reward it may not go here before it goes here. So that's bad risk reward with relatively low probability. Traders might do the opposite. And that's what happened here. This bar sold off and traders started buying the bottom third of the bar, scaling in lower. For stop entries, you can sell below 1. I would rather sell below 2. 1 has a tail below it, so really not ideal. If you sell below 2, you get out above 4. If you're still short bulls, they can buy 4, they can buy 5, they can buy 6. They can buy anywhere up, but they probably get out below 15. If they're still short on the way, if they're still long on the way down, they certainly get out below either 25, 30, or 32. I don't think they have to get out below 25. Strong enough bar 24 will probably get a second leg up. But anyways, traders get out somewhere here, and the bears they can sell. And where do the bears have to get out? I think they probably get out above 51 or 54, 55. But if they do, they sell again below 57 or the 66 bear breakout below somewhere in here. And then as far as bears, they probably get out above 68. Others will hold and then I'd get out anywhere in here. Just too much risk that we test the 66 breakout point low. So really not ideal. Limit orders, I thought buyers below 1, but they got trapped on 2. And therefore, they'll sell out of longs on the close of 2. And then I thought buyers below 10, but forcing bulls to buy relatively high. I thought sellers above 13, sellers above 14, and then buyers below the 19 low, but the buyers may not come in until far below the 17 low. So if you're a bull, you're not buying the low of 19, you're buying the breakout below 17 during 21. And then bulls, realistically, probably buyers below 25. But I thought sellers above 25, especially during 27, a second leg up after 24. Sellers above 28. And I thought sellers above anywhere in here, but really tough to sell. Buyers below 53. I thought sellers above 58. And I thought buyers below. And that's pretty much it for today. For buy the close, sell the close 2. You can sell the close at 3, but I would not. It's climactic with the big tail. I thought buy the close 5, buy the close 6, buy the close 7, buy the close 8. I thought 17 is more buy the close than sell the close. And then 21, second leg down after the bull breakout up to 12, probably more buy the close than sell the close. 24, same thing. Probably better to buy the pullback. And then I thought 34 was probably sell the close. But when you start seeing this overlap, I think it's tough to hold short and then probably sell the close 48, 49, 50. But you got to be really quick to make decisions because you're low in the range. And therefore, a pullback may be deep. And that's probably it for buy the close, sell the close. Let me take a look at a couple of questions. Okay, question. If you sold the close of 50 here, would you get out above 55 here after seeing bad follow through? And where would you look to sell again? Because after 56, there's mostly a trading range. Hard to trade. Yeah, well, for one, selling the close of 50, you know you're selling low in the range. Anyways, if you're selling down here, you know you're selling low in the range. And because of that, traders are going to be quick to get out above a bull bar and look to re-enter. Selling 57 or 58 or a pullback is reasonable. It's 2 legs up after a bear breakout, probably going to at least go sideways and form a trading range. But overall, it's tough. It's tough to stay short through here. By the time you see 67, it's tough to sell or sell the pullback. Not ideal. But this was a strong enough breakout. The odds were we would get a second leg and probably a test of the 3 close or the 3 low, which is basically what happened. Question, if you sold the 2 or 3 close, how would you manage the trade after seeing the bar 4 and why? Were there no sellers above 3? Is it because we're way below the moving average? Selling the 3 close was reasonable? Yeah, so I thought selling the 3 close was actually pretty dangerous. Bar 3 is a relatively big bar, and forcing traders to sell in the bottom third of the range. And it's reasonable to sell the close at 2, but with 3 being as big as it is, I thought there would be more traders buying the close of 3. 3 is climactic and it increases the odds of a pullback. Plus, you're near the low of the range. Traders didn't think this would happen, but the reversal up was so strong that the odds favored a second leg. And then this was strong enough that it favored its own second leg. And that's what happened here. Okay, last question. Can you make the argument for why bar 48 was not climactic and was likely to continue down? Well, 48 was it was climactic, but it was it was a bear breakout bar. And the bear breakout bar isn't bigger than any of the bars to the left. And it's breaking out below the bear channel. We have a spike in channel. And instead of forming a trading range, we broke below the channel. And whenever you get a breakout below a bear channel, it's resetting the leg count. 48 was strong enough that we were probably going to get a second leg down unless 49 was able to reverse, unless 49 was able to form a strong reversal bar and undo the breakout, which in this case, it was not able to do so. And that's why the market sold off. So where do we go tomorrow? Tomorrow's the end of the month. We have a bear bar, but it's forcing you to sell right at the moving average. Really not ideal. And therefore, because of all the overlap, I suspect buyers below and sideways. It is possible that we do gap down and test the low down here. You know, the open of the month will be important tomorrow. So we'll see what happens. All right. Thanks everyone for tuning in, and I will talk to everybody at another day.